So let's just start it off, guys, basically talking about, if I'm a Canadian and I'm moving to the States and I have investment accounts and retirement accounts up in Canada, what should I be doing when I'm moving south of the border? And then alternatively, we'll flip it the other way around as well. If I'm an American coming up to Canada and I have a 401k or an IRA, what are the kind of steps and also things I should look out for when I'm going through that situation? And then we can kind of just go from there. So perhaps, Shiraz, you want to kind of start it off in regards to a Canadian moving to the States, in regards to certain accounts they should have, should not have, and then steps they should take while they do that transition.
Absolutely. So that's a good question. I'd say first off, any Canadian that's moving south of the border, and Elena can definitely sort of attest to making sure that they sever themselves adequately from the country. She can talk a little bit about that. But from an investment standpoint and a retirement account standpoint, assuming that you earned your retirement accounts while you were legally a resident of Canada and you were legally entitled to have them, you're actually allowed to maintain them when you go over the border. That doesn't mean that you have to get rid of them just because you move. Now, the challenge will be is that you definitely need to make sure that you account for them appropriately. Sometimes it would be departures and adjusted cost base and step ups that end up happening depending on the scenario. But inside of a retirement account, like an RSP, for example, that's fairly clean and straightforward. You just need to make sure that you're with an advisor and an institution that is legally entitled to help you when you're a non-resident. So outside of that, what you invest in certain states can be a bit finicky. California, for example, is one that decides to not follow the federal governance on how to treat an RSP, and they actually pierce through it and don't consider it a tax-exempt vehicle. But outside of specific scenarios like that, in general, you can keep majority of your Canadian retirement accounts. So that would include an RSP, a pension, locked-in accounts. They can all be maintained while you're a non-resident. The one that's a bit tricky is a tax-free savings account. It's typically not recommended that you maintain that when you leave the country, and for the most part have to be liquidated. And your non-registered or non-retirement account assets have to be in country of jurisdiction. So the securities laws in both countries are actually relative to residency, not citizenship.
So Shiraz, on that same note, before I get to Elena, if I'm not with an advisor that's cross-border licensed, I'm an executive at Google, and I'm getting transplanted back down to San Francisco. What am I doing with my retirement accounts at that point?
So it's a good question. You either need to find an institution that will be registered to handle your account while you're a non-resident. So this would be referred to as snowbird registration. So most of the discount brokerages are actually not allowed to handle snowbird accounts. It really depends on their licensing. You'd have to check with your discount brokerage or your current advisory team, or if it's at the bank branch, whatever the case may be, on whether or not they're allowed to help you with your retirement accounts as a non-resident. Most advisors who are licensed professionals in Canada are allowed to get what's referred to as a snowbird registration in the United States. So they can apply to be able to handle your Canadian retirement accounts while you're a US resident. So that you can definitely do. And I would encourage that, Mr. Google, who's going down there, definitely make sure you do that.
Okay. And Elaine, on that same note, if I'm now with a licensed advisor on both sides of the border, I'm keeping my RSP up here and my other retirement accounts. I'm now, that Google executive in San Francisco. What are like the tax implications or things that I need to be aware of when I'm making that change with my accounts in Canada?
All right. So when you move into the States, you want to make sure that you properly cease your residency in Canada. Under the treaty, you cannot be a resident of two countries. Okay. And what determines your residency is, if you find yourself that you may be in the conflict, so what will determine your residency is the test, which is found under Article 4 of the Canada-U.S. Tax Treaty. Okay, so that's a tiebreaker test, and it has it defines ties, and you run through that test. You basically determine where your ties are with respect to your principal home, your social and economic interests, your abode, and if the answers tie you to the U.S., you are U.S. resident. So what ceasing residency entails is that anything you possess on the day of departure is subject to deemed disposition, as if you in essence sold that stuff. And Canada would tax you on built-in gains. Okay, so on appreciation, there are few exclusion. The assets which are excluded from deemed disposition, but there are very few of them. That would be your Canadian registered accounts, such as RSPs, or TFSAs, or RESPs. That would be your Canadian real property, investments in Canadian mineral resources. Everything else will be subject to immediate taxation, and including your home, which in California, which you might bought before moving there. And as I said, you are safe with me, and Shiraz mentioned that you are safe keeping the registered accounts in Canada. However, in California, California doesn't follow the Canada-U.S. tax treaty, which means that any Canadian registered accounts will be viewed as regular brokerage accounts. Okay, and what will happen that you will have to determine your annual income and adjust for California tax purposes. And it's not just California. There's quite a few states which do not follow the treaty. Pennsylvania, Ohio, New Jersey. So you really need to talk to your accountant to fully understand about your future tax implications. Clients tend to be very frustrated, right? Because administratively, it's a bit burdensome because they need to keep track now what's already taxed at the state level versus tax deferred at the federal level. So it just becomes a lot of work. Another thing, which comes often, clients move to the States and they realize that they probably want to remain in the States. They don't want to come back to Canada. And now they have this few little accounts which are still in Canada, which require them to comply with US Treasury or US IRS with respect to the disclosures. So what they would do, they'll say, listen, I just want to liquidate everything, right? I don't want to keep those assets in Canada. So what they need to be aware of that when it's a regular RSP, they can liquidate it at any point once they're no longer residents. Canada will hold back 25% withholding tax, and they will collect the balance. With respect to the U.S., if they crystallized, if on arrival to the States they were not U.S. citizens and they crystallized their RSPs, then presumably U.S. will have either nothing or very little to tax with respect to that liquidated RSP. When it comes to LIRA accounts, those work slightly differently because there's a 2-year holdback. So you cannot collapse LIRA right away. You need to wait for 2 years before liquidating it. And what CRA is now enforcing is that you actually need to provide a certificate of non-Canadian residency. So you will need to supply certain documents with the CRA, prove them that you in fact have not resided in Canada as a resident for the past 2 years, and only then they will issue an opinion and you will go to the bank with that opinion to liquidate your LIRA.
No, I appreciate that. And you brought up towards the beginning of that, the deemed disposition for assets, especially when a Canadian moved to the States. Is that, it's kind of a 2-part question. Does that include real estate? If it does, and I am kind of bouncing back and forth between Canada and the US, I know residency is a major component, especially from a tax angle as well. What country, if I own property in both countries, am I a resident of? Is there some sort of tests that someone like myself can follow or abide by? And if I decide I'm going to move to the States, what should I do with my Canadian property from like a taxation perspective?
Right. So as I mentioned, I mean, there are primary and secondary ties in the eyes of the CRA, and the primary ties are found in the Canadian domestic law and also under Article 4 of the treaty. And that would be your principal home, right? So if you have principal home in both countries, or none, no principal home, you stay on the friends' couches in both places, then you go to the second test. But if you have a principal home in one country, you need to stop there. So you're a resident of that country, right? So let's say you have both. Then you go to the next. It's your social and economic tie. So social tie would be your nuclear family, right? It's your wife, your spouse, and the kids. And the economic tie, that would be primarily your employment obligations. So whenever country you have those, that's going to be country of your residency. If you have real estate, so let's say you're Mr. Google, who is planning to move to California. He has this, great place in Toronto. It's appreciated quite a bit, and he's kind of torn, because they're really not sure how they're gonna settle in, and maybe they will return sooner than later to Canada. Like, we hear it all the time, right? Like, clients come and ask us, and like, oh, can you help us to make a decision? They're like, no, we're only gonna help you with a tax implications feedback. We can make a life decision for you whether you need to sell it or rent it. So if they want to sell the place, or if they consider selling that place, we're encouraging them to sell it before they cease residency in Canada. Okay, and the reason being is that when they sell it while residents, any proceeds, and presumably that's their principal home, any proceeds they're gonna collect, it's gonna be tax-free. Okay, there's no capital gain on disposition of principal home for Canadian residents, and there is no withholding tax on sale. So it's easy. Okay, you collect your cash, you move down south of the border. If you sell the property after you ceasing a residency in Canada, that gets a bit complicated. It gets a bit administratively inconvenient because what is happening? When you're closing on the property as a non-resident, the buyer is obligated to, well, actually you are obligated to get a clearance certificate. Okay, and so that if the property was personally used, that clearance certificate will be accompanied by 25% of withholding tax. Okay, but if the property was rental, that clearance certificate would be accompanied by 50% of the withholding tax. So if we have a mortgage on the property, that can become financially complicated, right? Because you're selling the property, let's say there's a 75% of the value is secured by the mortgage, you need to repay the mortgage, but now you have to lock 50% in trust until the clearance certificate is issued. So that's how the system works. And so what's happening on closing as a non-resident, you file the request for clearance certificate, you keep this 25 or 50% of the proceeds with the lawyer, the government approves on clearance certificate within around 90 days, and then releases the money. The lawyer releases the money to you, or partial money, and the rest goes to the government to fulfill your tax obligations in Canada. Okay, so that's with respect to the sale of your Canadian home. When it comes to renting it out, there's also a lot of paperwork. So because you can rent it out under one of the two scenarios. You can rent it out on a net remittance basis, or you can rent it out on a gross remittance basis. So the first option is available if you have a Canadian resident withholding agent. okay? And in your tenant cannot be that agent. So it needs to be either family or friends or your property manager, so whoever would be willing to be that person, in charge of your remittances, and you fail to, if the remittances are failed, then that person will be basically facing the Canada Revenue Agency for non-pay tax. So good luck to find volunteers for that, right? But what it does on the net remittance basis, it will allow you to remit 25% tax on the net rental income, okay, as opposed to 25% on your gross rental income. So a net remittance basis requires you to file 3 sets of paperwork annually. Lots of clients don't like that. If they if some of them saying, I don't want to, I would rather forego this 3 separate deadlines and paperwork. I would remit this on a gross basis and collect the refund at the time I'm filing the return. Okay, so that's happening on the Canadian side. On the US side, you also have to watch, because you have to report that rental activity on your US federal return, and the tax paid, that 25% tax you pay in Canada, you can credit on the federal return to the IRS. If you're a resident of California, California does not recognize foreign tax credit, you out of pocket. Okay, so what it means for wealthy California residents with Canadian real estate, you may end up paying 38.5% of tax. Okay, so kind of expensive.
No, I appreciate that. On that same note, though, let's just stick kind of with the Canadian moving to Cali and selling that home. And sure, as if you mentioned that I'm able to have some registered accounts, right? Hold on to my RSPs and that. I want to talk about if I'm selling a home in Toronto, and the average home here is about $1 million. So let's say that I sell it. That's obviously, that amount of funds is going to considerably bypass my thresholds for RSPs and some of these registered accounts. If I'm moving, or in the process of moving to California to work for Google, what am I doing with that $1 million? Am I moving it down to the States? Am I putting it, like, can I even have non-reg accounts in Canada? Like, what are you recommending with that $1 million proceeds while I'm moving to the States from my Toronto property?
So that's another great question. Also very loaded, because there isn't one right answer for all. It really depends on a person's circumstances. So number one, if you have the proceeds from the sale of a home, as Elena mentioned, that's not subject to capital gains tax. So you effectively can earn that money tax free. So if you have 7 figures in that amount, that's a pretty sizable sum. So most people want to shelter that monies in some sort of retirement account. That way you can at least continue to compound that money on a tax deferred basis. So whether that be on either side of the border would typically be recommended. But since you haven't moved to the States yet, you have no US sourced income. So you can't actually use any of the US retirement accounts yet, right? But you are still a Canadian resident. So the typical and the conventional wisdom would be is to try to maximize whatever past service contribution room you would have left in Canada. So assuming you haven't maxed out your RSP to every single dollar you could put in, most people haven't done that. But assuming you haven't, you try to eat up as much of it as you can. But let's be realistic, at $26,000 per year, depending on how old this person is, they don't have that much room realistically. Eating up 7 figures is not an easy thing to do. So you can make a small dent in it, but the reality is that the balance of it will likely just have to be held in cash and taken over to be invested in the future in the United States. So and again, because securities laws are residency based, that would have to go with them to country of jurisdiction. So he sells a property in Canada, you have the proceeds, eat up whatever you can in a retirement account, and then be ready to transport the balance with you to the US into a brokerage account. And then down the road, hopefully using the US retirement accounts like IRAs, Roth IRAs as applicable. And hopefully your employer has a 401k plan.
Is it complicated moving that money down to the States?
It can be, but it shouldn't be, but it can be. So let's just put it that way. They don't make it easy. I always have this running joke. It's easier to move your phone over the border than it is your money. And it's just an unfortunate reality. Anything over $10,000 is a reportable amount. So people like myself who are cross-border licensed, the easiest way for us to actually help people do that is to actually open up an account in Canada under an individual's name, and then once they move, open up a further account in the US under their name and effectively transfer it internally. That's one of the cleanest and easiest way that I've seen to be able to do it. However, if you have your investment or you have your monies in a brokerage account in Canada, period, when you leave, a US brokerage account should be able to do a transfer directly. And again, I use the word should.
Okay. Elena, let's talk about, if I'm an executor, once again, sticking on the whole cross-border theme, but let's say I'm that Canadian moving to the States, was really left some assets or, in the US, but I'm still a Canadian resident. Like, talk to me from a tax perspective of a Canadian resident. Like, I have not moved to California yet, so I'm that Google executive, right? But I've inherited some assets in the States. How do I go about doing that where I'm going to be moving to the States, but I have not yet already?
Okay, so your favorite uncle has passed, and now you got what did you get? You got a piece of real estate, or you got portfolio? Like, we actually need to go on an asset by asset basis to figure out what's going on. Also, we need to know who is the executor or who is a trustee of the estate, right? Because if the trustee or executor is a U.S. resident, then it's a U.S. estate, and you're just gonna get, the distributions.
Let's say it's me though, as a Canadian.
Oh, you are.
Yes.
Oh my goodness, you're gonna be busy, Grant.
So I'm the executor. I'm also obviously inheriting some of this stuff from the family, but I'm in the process of moving. So I know that's
don't do it.
Sticky situation. Okay, all right, okay. But I have to. I'm getting relocated to California for Google, right? So I know it's
for an extension.
Okay, I'll go to the boss.
Well, it's quite a process, I can tell you, because it's complicated. The reason what causes that complication is because once the majority of the trustee or the sole trustee is a Canadian resident, then the estate becomes a Canadian resident estate. So it doesn't matter that your uncle is a US resident and all the assets in the States, the trust itself, the testamentary trust, the estate, is another Canadian resident. So what will happen is that you have Canadian tax obligations, reporting obligations and tax obligations, and you will have to deal, with a US lawyer because there's still going to be US probate on those assets because the assets located in the States. So first of all, you need to figure out, again, we can talk on that subject for days, but very high level, you need to figure out how those assets, the assets of the decedent, were held. Were they in a living trust or they were held outright? Okay, because that will change the taxation and reporting and stuff like that. So if they were held in a living trust, what you would like, Grant, I have this story which comes to my head, and it's kind of bad. So what you want to do, you don't want to inherit those assets outright. You don't want to be a personal individual beneficiary of the living trust. You want your personal trust be a beneficiary of that living trust. Okay, and the reason why I'm suggesting that is because from the US perspective, when we have a living trust, the assets are commuting back to the owner on death, okay? And they get a step up in basis, okay? As if the owner held them outright, as if your uncle held them outright. From the Canadian perspective, trust is considered a separate taxpayer, all right? Which means that when you are inheriting assets as an individual, you're not gonna get a bump up in basis on the day of uncle's death for Canadian purposes. If the uncle bought, Johnson & Johnson in 1978, okay, that is gonna be the basis of the shares you're gonna be getting from the Canadian perspective. So it can become quite complicated. So what we've been, if we're catching clients on time, we actually had a case just very recently. We had to keep someone on life support to make sure that the will is properly executed, okay, or the trust agreement. So we had to substitute the individual beneficiaries with personal trust beneficiaries, okay, just for that particular purpose. But you know, let's go back to, you know, kind of a more high level discussion. Sorry, I tend to go into minutia here. You know, if you need to go on an asset by asset basis, and what will happen is, you know, you need to determine who has the right first right to tax those assets. Okay, so when it comes to U.S. real estate, U.S. will have the right to tax. Canada will have a secondary right to tax. When it comes to securities, it's a personal property. Canada will have right to tax, and U.S. will not have right to tax those assets, and so on and so forth. But again, as a you know, trustee, you will have to do a lot of you know, there's just a lot of work on your shoulders to go through the process, to be compliant on both sides of the border, to get the clearance certificate on both sides of the border. So if I were you, I would clearly not take the assignment at the same time, the California assignment.
Well,
okay,
so why don't I jump in on at least one other asset, at least that's a common one, just as an FYI. So it's in the United States, they have a different type of retirement account that we have in Canada called the IRA, or individual retirement account. The one major difference, and again, this has been kind of put, and there's a major change that happened recently, but you can name almost anybody as your beneficiary of an individual retirement account, including your neighbor. So your uncle, in this case, could have easily named you as a beneficiary of his retirement account. And also, if you had a government sponsored plan, let's say you had a 457, or you had a 403B deferred compensation plan, you can name all sorts of people as beneficiaries. They don't have to be next of kin, right? The way that we do in Canada. So it can be a little bit different. So they have enhanced planning opportunities, which were amazing, and they're less good now, but they were still really good. So in the end of 2019, the US federal government came out with a new proposed change to increase the age at which you are required to start withdrawing from your retirement accounts. That did so at the expense of really eliminating, or frankly making it a lot harder to deal with a retirement account on an inherited basis. So when a person passes away with an individual retirement account, it creates what's called an inherited or a stretch IRA account, which means that a beneficiary can then take over ownership of that account, still maintain taking money out as you needed to, but you can really defer that tax for a lot longer. You didn't have to take a giant hit. Recently, at the end of 2019, the government in the US changed that to say it could be almost in perpetuity until you depleted the asset. Now you have a 10-year window in which you actually have to take out all the money within 10 years. It's still better than we have in Canada, but it's still there.
Right. It's interesting that you brought up about the beneficiaries. I mean, as long as they're humans, they can be beneficiaries. And in fact, they don't have to be.
My dog can't be the beneficiary.
Well, it depends how much human the dog is. But what interesting is they don't have to be a named beneficiaries on the IRA. Okay, they can be actually beneficiaries through your will. It's like literally U.S. government, going through and saying, okay, so who is gonna at the end of the day be entitled to your assets? What you need to be aware of from the Canadian perspective is that if you grant is a beneficiary of your uncle's IRA, is that you would have to you would need to notify the bank that it's you, provide them your tax ID. Hopefully you have one, and if you don't, you need to apply for one. You're not going to be eligible for Social Security number, so you will have to obtain an individual taxpayer identification number, ITIN. And then the custodian will withhold 15% at source tax and pay you the balance, okay, of that IRA. And if you are collecting the lump sum distribution, okay? So very often custodians actually holding back 30%, okay? They're foregoing the treaty reduced rate and they're just doing it under the domestic law. So what it will mean that you would be responsible for filing your own US tax return later to collect the over withheld 15%. You will be required to report the distribution on your Canadian return at gross, and you will only gonna be eligible for a credit for the correct 15%. So if you, if the bank holds back 30% and you just don't wanna be bothered with filing return to get 15% back, and you say, I'm just gonna report the entire 30% as a credit in Canada, CRA will tell that you gratuitously gave the US government 15% because the credit will be limited to the correct 15% under the Article 18 of the treaty.
Okay. So
just sort of one more thing just on that note, because this is such a loaded topic. We see it all the time.
It is a loaded topic.
It's a really it's really how deep down that that rabbit hole do you want to go. But what you see is that there's a lot of tax planning that people do on for postmortem purposes in the United States that frankly isn't as applicable here in Canada. Like they use trusts very prevalently in the US. We don't use them as commonly in Canada by comparison, just due to the fact they're not very tax favorable here. We've run into numerous circumstances where an individual named their trust as a beneficiary of their retirement accounts, and it's perfectly good planning
in
for
Canada or in the US.
In the US, they named their trust as a beneficiary of their retirement account in the US, and instead of naming their actual beneficiaries directly by name. And that caused a giant problem, especially when you have, in your case, Grant, a non-resident beneficiary of a trust. So you name, because you can actually roll the funds directly into the name of the beneficiary in effectively creating what's called an inherited IRA rollover. That's totally doable. But when you put a trust in the middle, that really complicates things, because now you have what's referred to as a two-step rollover, which not every institution A will allow, and B, it becomes very complicated because now you have effectively a game that you're playing with the IRS and trying to make sure that who is actually the beneficiary, and of that, then they have to make sure that the trustees are not going to come back and try to claim anything else on the trust and try to take the funds away. It can become a real nightmare, and we've gone through a bunch of these things on our end as well. And we typically advise that some things are really good planning for American residents, but if your beneficiaries are outside of the United States, you really want to make sure you're getting really good cross-border counsel to see whether or not you set your accounts up appropriately. Otherwise, you could be running into nightmares where it could take you months, if not years, to try to affect that what your wishes were.
So on that note, let's assume that my uncle had an IRA and he left it to kind of two ways. If he left it to the trust, right, which then would be part of my job as the executor to work through the estate and all of this, but I'm still Canadian. What happens then? And then number two, if he didn't leave it to a trust and he wanted to roll it over to me directly, as you were saying, how would he do that if I'm not even an American resident?
That's a good question. So the latter is the preferred method because it's cleaner, simply because he can actually name you as a beneficiary in any of his documentation, or as Elena mentioned, in his will. And you could then become effectively the future owner of that asset. And you could either create what's referred to as an inherited IRA or stretch IRA under your name and then maintain a tax deferral for a period of time. Or you could take a lump sum, like she mentioned, and pay the withholding tax. That's option two. Option one.
And I'm able to do that as a Canadian resident.
Correct. So you have to file for an ITIN, like you mentioned before. Make sure you have a tax identifier number, but you're legally entitled to have that asset, even though you're not an American resident. So that's okay. Yep. If there were distributions being paid out by your uncle to himself, you'd have to maintain that going forward. And there'd be in a percentage that you'd have to take out every single year. It's intended for you to try to take out majority of the money over your life. It used to be awesome because you could be able to stretch it out for the period of your life. Now you can do it for 10 years as of the end of 2019. So that's one point. But had he named his trust as a beneficiary and then you the beneficiary of the trust, that complicates things, because then you have to create what's called a pass-through type situation where they have to look through the trust to ultimately see that you're the beneficiary. And some institutions have a problem with that. It opens up increased liability. It opens up a lot of sort of a whole other can of worms. So in order to help potentially minimize your probate tax situation in the US, you potentially subject you, Grant, to income tax in Canada.
Gotcha.
Which is a whole
Okay.
other can of worms.
So that's good. I think it's important for any Americans to just, or Canadians to know that all of this stuff really, guys, before they go down there. But I wanted to kind of continue with this example of,
Grant,
you know,
Grant, can I interrupt you? So you know where we see that quite a bit. It's not as much. I mean, inheritance is a big part, but you know, considering how mobile Canadians are, right? We see that a lot when you know, Canadians used to work in the States. They had 401ks, they have IRAs, and then they're coming back to Canada. And then, you know, they are now the owners of their accounts, and they are passing, because that's another layer of complications, right? So I would say when it's just a pure inheritance, that, I mean, it's quirky, but it's not as bad as actually passing with the IRA or 401k
Okay.
here in Canada.
So I think, no, it's a good point, and you got 2 steps ahead of me. What I wanted to do was keep with the example of me going down there. Let's say I work with both you guys. We figured out the whole estate. Everything is good. I'm working in San Francisco with Google, but then enough's enough. You know, I want to come back and I want to move to Muskoka, come back up to Canada, maybe the wife or whatever the personal situation is. But because I'm down there now I have my 401ks and all of this sort of stuff, right? So I want to kind of almost ask you guys the same questions, but now the reverse. So now I am a American resident, still a Canadian citizen. I never renounced my citizenship at all. And now I'm coming back home, basically. But I have non-retirement and retirement accounts up there. So Shiraz, maybe you can talk to me about what accounts I should keep. And then from the ones I keep, Elena, you can talk to me about the tax consequences from those ones I'll keep down there.
All right.
Cool. So first stab would be is that number one, it's the same rule. So the United States is one of, I believe, 3 countries on the planet that have a 2. I thought it was 3. There's North Korea, Eritrea, and
North Korea. We're not counting that.
That's fine. No,
we don't know what's happening there.
Fine. So Eritrea and the U.S. 2 then. That have a global reporting requirement for citizens, right? So they tax based off of citizenship, or if you're considered a U.S. person, that'd be a green card holder or a citizen. But securities laws in both countries are residency based. So it's where you physically that dictates what you can and cannot do. So in this example, while you're still in California and you're still in San Francisco, and before you come up here, if you have, let's say for argument's sake, a 401k with your employer, no problem. If you have an IRA or a Roth, those are also no problem. You're legally allowed to maintain those, even if you cease residency in the US. The challenge will be is that what are the consequences of doing that? So unfortunately, the securities laws require that the moment that you move over that border, let's say you actually come to Muskoka and you're actually living in Canada again, in that scenario, the moment that you moved over the border, you're effectively, for all intents and purposes, frozen out of all of making any changes to your US retirement accounts. So the way it was the day before you left is the way it will be until further notice. Unfortunately, it's not ideal. It's mostly due to the fact that there are very few U.S. institutions that are licensed to handle a non-resident.
So how do I get around that then?
So you have 2 choices. So number one, depending on the scenario. So number one, which is a problem we've encountered with a lot of existing people, depending on how you came back. So if you're still employed by Google, but you're working in Google Canada instead.
No, I retired. I'm chilling out in Muskoka. Yeah.
Okay, so the good life. Okay, so that's a lot cleaner. So you can do what's referred to as a 401k rollover. Okay. And this is almost the most recommended method of doing this. Is some people try to move them into Canada directly, and depending on how much money you have in your 401k, if you have a pretty significant balance, that might not necessarily be the cleanest thing to do. If you have a small amount, let's say you only had, $10, $15, $20,000, it might just be worth it to try to, roll it out into a Canadian RSP or something of that nature. But if you have, multiple 6 figures, if not 7 figures, as we've seen more recently with a lot of folks, that can be a large sum to try to even attempt to absorb into Canada. So typically is if you don't have to, don't, is the conventional wisdom, right? So maybe roll it over into an individual retirement account, an IRA in your name, and then maintain that despite the fact that you're a Canadian resident, which is something we do routinely on our side, but it requires the advisor and the firm to be licensed where you are. which we're one of a handful that are. There are some others that are as well. You need to make sure that whatever institution that you're dealing with can affect that rollover for you. And that's the main thing, that you want to make sure that you can maintain that tax deferral and then get self-directed capabilities over it and maintain being able to change your assets as you see fit. You know, just like we're in the environment right now where active is a good thing. If you're in a sort of set it and forget it like you were when your 401k once upon a time, then you're kind of living with whatever it was when you left.
So you mentioned a Canadian coming to the U.S. probably, you know, for more intense purposes that should not have a TFSA. If I got all those accounts in the U.S., are there accounts that I should not have when I move back to Muskoka?
Yes. So the only one that's really a problem that's tricky is your non-registered or retirement or non-retirement accounts.
Okay.
You can maintain having a Roth.
So if I have a brokerage account or something with Fidelity or whatever.
Yes, so that can come.
Gotcha.
That would actually have to come with country jurisdiction. So think of your non-retirement assets as luggage. You have to take it with you wherever you go. Okay, you can't leave it. But your retirement assets are like kind of like your homes. Those can stay put. They have strong roots and they can stay wherever they were. The one that gets a little bit tricky, that's a bit of a hybrid, is the U.S. equivalent. I'd say, or the closest equivalent to a TFSA in the U.S. is a Roth IRA. And that one there can be a bit tricky because the withholding taxes have to be held at a higher amount. You can't apply the treaty amount on a Roth IRA, at least depending on your institution. That's an unfortunate reality that we have right now.
Okay, no, that's important to know. So Elena, with my 401k and IRAs that I have and trusts that I can kind of keep in the U.S., when I moved back to Muskoka, what are the tax implications or complications of me holding these U.S. retirement accounts while I'm a Canadian resident and still, I guess, citizen?
All right. So when you're establishing Canadian residency, you allowed to revalue your assets. The new valuation of your assets will be equal to market value on the day of arrival. Okay. So if you bought a Google share for, I don't know, $1,000 and now it's $2,500, so that is going to be your new cost basis for Canadian purposes for future disposition. Right. So that step up is not available for any U.S. retirement accounts. Their basis remains historical. So so now what you technically need to do, you need to keep two sets of books. Okay. The two sets of books would be required if you are a U.S. citizen who comes back to Canada. But if you've been in the States for 20 years on various visas, not a green card, right? You had E2 and you've been renewing it every 5 years.
Which, for example, would be my case working for Google. We just kind of kept on rolling that.
Sure. That would be a better case scenario. So what will happen is that when you come back to Canada and have those non-registered assets, I want to emphasize that any appreciation which happened during your U.S. residency, they're in essence forgotten. They're written off. Okay, so when you bought a Google share for $1,000 and now it's $2,500, and you established a residency yesterday and sell the share today, in Canada you will be paying tax on appreciation of that Google share between yesterday and today. The growth between $1,000 and $2,500 will be forgotten from the U.S. perspective. So we'll have this opportunity, this planning opportunity for return residents. We're very happy when we can save them a lot of money, just because, again, how the personal property is taxed. Okay, so with respect to your U.S. pensions, here's a few things to bear in mind. When you come back with your Roth IRA, you need to make an election and send that election to the CRA, notifying them that you're establishing a residency with Roth, and provide the value on the day of arrival. So when you receive future distribution, the treatment in Canada will be aligned to treatment in the States. Okay, you're not allowed to invest into Roth after reestablishing the residency in Canada, because if you add even $1, you're tainting the account, Now, instead of registered, is become just a brokerage account. So what will happen, you now have to recognize any income generated in the account and also disclose it on Form T1135 foreign asset verification statement. So it's more work, right? So now it's tax-free in the States, taxable in Canada, defeats the purpose. So also when you come back with, let's say you come back with 401k and IRA, and you're retired and you have a spouse and you decide to income split. Okay, so you draw annual incomes from your 401k and IRA. So what you need to be aware of, that you can only income split the income which is coming from 401k. You are not allowed income split from IRA. Okay, so in many, if income splitting is important to our clients, because we have one spouse who is a wealthier and the other one who is less, so what we suggest is perhaps to roll that IRA into RSP, because then you can income split from RSP.
Okay. Wow, guys, covered a lot. I've moved to the US and back and inherited a trust along the way. So honestly, I think that, we could probably go on forever with this type of stuff, right? But I think on a high level, at least now, like from all the questions we had here, a lot of it's been answered. So if there's things that I think, like, from what I want to do, guys, it will kind of end it there.